Hi everyone, welcome to today's webinar, Navigating U.S. Expat Taxes in Retirement. I'm Natalie Goldstein, CEO of My Expat Taxes, and I'm really excited to walk you through this because as an expat myself living abroad, this is obviously a very important topic. I'm a little bit further away from retirement, but it doesn't mean I'm not planning for it already. And whether you're planning for retirement, you are already retired, or you're about to retire, there's a lot of important information to know. So let's jump into it. What we'll talk about is retirement income and how that's taxed. If you're still contributing to your IRA, what are those contribution limits? And of course, what happens to your US Social Security benefits if you're entitled to them? Or what happens to your foreign pension income if you're planning for that to come as well? So in general, if you have retirement income, you have to understand what of that income is taxable and what's not taxable. Basically, your worldwide income is reportable. So you always have to report all types of income, whether it's US Social Security benefits, if it's foreign Social Security benefits, US pension, foreign pension, etc. So by default, as a US citizen or a green card holder, you know that when you're filing your US tax return, your worldwide income is reportable. Now, is it taxable? That's a little bit of a different topic. So let's walk through the different types of common retirement income. Social Security benefits. It might not actually be taxable. If you're only earning US Social Security benefits, normally that income is not taxable. If you are earning US Social Security benefits with other types of income, you might reach to a point that your US Social Security benefits are taxable up to 85%. If you're married filing separately, which is pretty common for expats that are living abroad and married to non-US citizens, you can expect that your US Social Security benefits can be taxable up to 85%. Now, with that being said, what's really important to know is what country do you live in and what does that tax treaty say? Because in a lot of countries, the tax treaty will actually specify where Social Security benefits are taxable. And some countries will specify that the paying country is the one that can tax it, and others will specify that the country you live in, your residence country, is where that income is taxable. So Social Security definitely has a different layer on it. So one is it even taxable by normal US tax standards based on your other income or your filing status? And then the second layer is where are you living and what does that tax treaty say? Because even if it is taxable by this default US tax law, the tax treaty can override that and say, actually, this income is only taxable in the country that you reside in. So basically, it depends for US Social Security benefits. Now, the next part is traditional IRAs or 401k distributions, right? This is all assumed to be pre-tax contributions that you made, meaning that when you distribute from these type of retirement accounts, that income is fully taxable on a US tax return. It is extremely rare that any tax treaty will allow you to use any type of clause like I mentioned for Social Security, just because there is a savings clause saying that most tax treaties are pretty useless for US citizens and green card holders. I'll backtrack a little bit because now you're probably confused. A tax treaty will normally specify where your income is taxable. If you read it at face value, it seems to make a lot of sense. Pension income is taxable here, or pension income is taxable there. Now, the problem we have is that there's a savings clause in pretty much every tax treaty. This savings clause then says if you're a US citizen or a green card holder, or even if you gave up US citizenship in the last 10 years, sometimes that clause is also there, none of this really applies to you except for maybe 5 different benefits. Now, in those 5 benefits, the one that's normally in that is Social Security. But normal pension income that's not Social Security is normally not included in the exempted benefits. So now we get back. While Social Security, you might be able to use a tax treaty, don't rely on that for traditional IRAs or 401k distributions. Just know that if you made it with pre-tax contributions, which is the norm, normally that's what you do, it's all pre-tax, that means that when you distribute from these accounts, it is fully taxable on your US tax return. Of course, if you're also taxing this income where you live, you might be able to claim foreign tax credits. Now, Roth IRAs. If you have a Roth IRA, it's different than a traditional IRA because a traditional IRA is pre-tax. A Roth IRA is after tax. You make it with after-tax contributions. You did not claim that tax deduction when you made the contributions, way back when. So now, if you're making a qualified distribution, that entire distribution, your contributions plus the earnings, is completely tax-free in the US. You would report it as your total distribution, and you would report zero as taxable distribution. So that's pretty cool on a Roth IRA. Obviously, depending on where you live, that might not be the same as the country that you're in, and they may not recognize the tax benefits of a Roth IRA. Some countries do. Some countries have a tax treaty that says, okay, for Roth IRAs, we'll recognize that they are tax-free at distribution, but that's definitely not the normal case. So watch out for your Roth IRAs. If you're distributing them while you're living abroad, you might face taxation abroad, even though you're not facing taxation normally in the US. So maybe you want to plan it a little bit more that you're distributing your Roth IRA when you're actually residing in the US. So, foreign pensions. If you're having, not a type of foreign Social Security benefit pension, because obviously foreign state pensions are like Social Security. In that case, you can go and refer to your tax treaty. Are Social Security benefits taxable by the paying country or your resident country? If it's taxable by, the resident country only, or even the paying, I guess, because you're living abroad, that means it's generally not taxable by the US. So that's for foreign state pensions, which is essentially Social Security. Now, if you have a foreign company pension or you have some type of private pension, do not rely on the tax treaty necessarily for that. There's about 1 or 2 countries that do allow some type of exclusion, but again, that's not the standard. The standard you can expect is that your foreign pension income is fully taxable in the US, but of course, you can claim foreign tax credits. And of course, only anything that is considered earnings or, pre-tax money is then taxable. What that essentially means is as you're contributing to your foreign pension accounts, it's very common that as you're contributing to them, you're actually going to report those contributions on your US tax return in the year and receive no US tax benefit. So that goes to your basis. And then when you draw from your pension, you're not taxed twice. Anything you've already reported to the US in the form of your gross salary or your employer's contributions to your pension that's already been taxed, that will not be taxed again when you withdraw from your pension. But the hard part is you have to know what is your cost basis so you can understand what's the tax-free part of that pension distribution. Of course, that's a little bit tricky, and we are really happy to help you with that at My Expat Taxes. And we have this great new planning product where you can actually go and use a calculator to figure that out as well. Okay, that covers, I think, the general types of pension income. But when you're retired, you're probably also looking at other income streams such as dividends, interest, capital gains. With that being said, if you do have additional investment income, consider it will be taxable. It's going to be taxable on your US tax return. You can claim foreign tax credits. If you have qualified dividends or long-term capital gains, so any type of capital gains held for over 1 year, that can be taxed at reduced tax rates, so anywhere between 0 to 20%. And that pretty much covers, I think, a very general outlook at different retirement income streams and how the US would tax said income streams. So the next question naturally is probably, do you even have to file a US tax return? And if so, what is tax-free and at what point do you start getting taxed? As you can see on the screen, there's a lot of different thresholds for your filing status and based on your age. Keeping in mind that if you are over 65 or if you're filing with another US citizen or just you're filing jointly with maybe someone that elected to be treated as a US tax resident, if both of you are over 65, these thresholds can further increase. Now, the thresholds are generally the same as your standard deduction. So that means that you don't have to file a tax return unless you're over the standard deduction, because the standard deduction means anything under this deduction, this amount is not taxable. Now, I do want to call out It's a little bit different if you're married filing separately, because the standard deduction for married filing separately is the same as if you're single. However, the filing threshold is extremely lower, because if you're married filing separately, even if your standard deduction is, as high as the standard one or as high as the single one, your filing threshold is only $5. Yes, only $5. So if you have over $5 in interest income, you have to file a US tax return. You may not be taxed at all because your standard deduction is in line with the single filers, but you do have to file a tax return. Now, another part of that is if you have self-employment income. If you have self-employment income over 400 US dollars as net profit, even if it's not your main job, you have to file a US tax return because the US needs to assess if you owe self-employment tax. Those are kind of the exceptions on when the standard deduction is not the same as the filing threshold. But generally, if you are under the standard deduction, that means none of your income is taxable because that's your standard deduction, and that means you don't have to file a tax return. But if you're over the standard deduction, you will have to file a tax return, and then any amount of income over the standard deduction is taxable. However, you can claim credits, foreign tax credits, deductions on it, etc. Jumping to our next topic for today, individual retirement accounts, IRAs. I think sometimes people call them IRAs. I will always just call them IRAs. So, IRAs. There are two main types of IRAs, as I mentioned before. There's traditional IRAs and Roth IRAs. There's actually a few more, but let's just focus on the main ones before we confuse everyone. So when you are saving for retirement, a lot of US citizens will opt to also contribute to an IRA because it's an additional retirement account. So obviously, as you're going through it, you have, maybe your 401k with your employer, you have Social Security that you're, always contributing Social Security taxes to as you're working in the US. And then you also have this opportunity to make a private, personal, individual retirement account, an IRA. And so with an IRA, what you can do is you can basically contribute up to the maximum defined threshold per year that the IRS sets to these different accounts. And you'll choose between a traditional or a Roth IRA. Traditional is pre-tax, meaning that you can contribute $7,000 to a traditional IRA and then immediately take that $7,000 that you contributed as a tax deduction on your tax return for that year. What that means, though, is that when you distribute, as I mentioned, from this traditional IRA, the entire thing is taxable because you took a deduction for that $7,000 contribution, so that that contribution and any earnings related to it is then taxable in the future. A Roth IRA works in an opposite way. You can make a $7,000 contribution. You don't take any deduction in the year you contribute. However, that entire amount, the $7,000 contribution you have in there, plus any earnings related to it when you withdraw from your Roth IRA, is completely tax-free in the US. So these are very popular, additional retirement accounts. And as you're living abroad, you may think, oh, what a shame. I can't contribute to such a nice tax-favored account. That's not true. If you're living abroad, you can still contribute to an IRA. However, you do have to be more mindful because the amount that you contribute to an IRA, it has to be the lower amount between the annual IRA contribution limit, right, which is around $7,000. It can be higher if you're older than 50 years old, or your taxable compensation. Taxable compensation can include foreign wages and self-employment income. I think that's the biggest misconception. Everyone thinks taxable compensation means that it has to be US compensation. No, it can be your worldwide compensation. However, it must be taxable. So if you're using the foreign earned income exclusion, which effectively makes your compensation not taxable, you may not have enough compensation to contribute to an IRA. So if you want to contribute to an IRA as an expat, you generally can. Just watch out. What expat tax benefit are you using, and do you have enough taxable compensation? So that's where My Expat Taxes can obviously help you out, whether you're using our planning tool to figure out how much taxable compensation you think you will have, or whether you're filing your tax return with us earlier in the year, hopefully before April, so that you can actually model your tax return, enter in your contributions, and you can see, was my contribution allowed, or am I now subject to a 6% annual access contribution tax and I now need to withdraw my contributions, or, figure out some other way to contribute. Now, I do want to call out for Roth IRAs, there's one additional qualification, so to say, you have to meet. If your income is too high, if your modified adjusted gross income, I know that's a mouthful, but effectively just means if your adjusted gross income, adding back any type of foreign earned income exclusion or some other types of exempted income, if that is over the threshold set for that year, you cannot contribute to a Roth IRA, which can be very unfair for those that are married filing separately that are still living with their spouse, aka most Americans living abroad that moved abroad for love and are not married to an American and are probably married filing separately. Because if you earn over $1, which you have to in order to contribute to an IRA, you start getting a phase out limit. And if you earn 10,000 US dollars or more, you can't contribute. That doesn't mean we just throw in the towel and say, I quit and there's nothing I can do to help myself have a better retirement. That just means, what's the strategy? How do I implement this strategy? And there's always, if there's a will, there's a way, generally. So in this case, it's a backdoor Roth IRA conversion. You can contribute to a traditional IRA that doesn't have this income limit, this modified adjusted gross income limit. You can contribute to that. You can then roll it over to a Roth IRA. And then you make your original contribution non-deductible. I've probably just given you a headache with this scenario. So again, this is probably where it's going to be a little bit more handy to get in touch with our tax professionals, plan out your situation a little bit more, or work in our premium tier to just understand, okay, well, where should I contribute? How do I report this on my tax return to make sure that I'm doing this properly and that I'm not being subject to a 6% annual access contribution tax, because that tax is really not fun. And it's annual every single year. So IRA contribution limit for 2025 is generally the same as the one set for 2024. It is $7,000 and $8,000 if you're 50 or older. So if you're contributing to multiple IRA accounts, if you're contributing to traditional and Roth IRA accounts, the total amount that you're contributing to all your IRAs for that year cannot be over the IRS-defined maximum. Another pot of retirement income to draw from, Social Security. And Social Security generally happen in every country you live in. Not every, but most countries. A lot of countries. A lot of countries will help you have some type of Social Security benefits, state pension income when you retire. And let's look at how these types of incomes will work. So let's focus more on the US side first, right? If you have worked in the US, you probably have paid some type of Social Security tax. And this means that you contribute a certain amount of credits to Social Security every single year. The maximum you contribute per year is 4 credits. So generally, if you've worked in the US as an employee or self-employed, etc., if you worked in the US for 10 years, you probably would be eligible for Social Security benefits, assuming that you had gotten your 4 credits per year, because you need a minimum of 40 credits to draw from US Social Security. The actual amount you get from US Social Security is based on the actual income you earned every year. But there is a minimum threshold to even pool from US Social Security. Now you're probably thinking, darn it, I only worked in the US for 9 years and then I left. I lost everything from my Social Security. That's not the case. You could actually still contribute to your US Social Security benefits account from abroad. If you are still self-employed, if you are, it doesn't even have to be your main job. If you're just picking up some side jobs, some content creation, writing blogs, if you have some type of self-employment income, you file this on Schedule C of your tax return. It's over 400 US dollars. If you pay that 15.3% of self-employment tax, even if you're abroad, you can still contribute to your US Social Security benefits account. And then on top of that, if you are living in a country with a totalization treaty, and this is not on the slide, so focus on me. If you're living in a country with a totalization treaty with the US, you can actually ask the US to consider your time worked abroad. So that if you have at least some credits in the US and then you're working in Germany, you can ask to say, consider my time in Germany as well. And that can actually get you to that 40 credit minimum. Again, any income that is not actually, tax in the US for Social Security tax, it's not going to contribute to the amount that you actually earn. But at least you can consider your time abroad to get you to the minimum threshold to pull Social Security benefits out of the system, assuming there are some at the time you retire. So that's US Social Security. I already talked briefly in the beginning about how that's taxed, but I'll repeat it as well. If you have US Social Security, it can be taxable up to 85% of the amount you get. If you're married filing separately, generally you can expect 85% of your Social Security to be taxable. If you have other income streams aside from just Social Security, you can expect up to 85% of your Social Security to be taxable. If you only have US Social Security, you don't have any other type of income, you normally don't even need to file a tax return and your Social Security should not be taxable. Now, let's assume it is taxable. If you're living in a country, check that tax treaty, or let us check that tax treaty for you, and figure out which country has the taxing right on your US Social Security benefits. Is it the paying country, aka the US, or is it your residence country, aka where you reside? If it's your residence country, then that means it's not going to be taxable on your US tax return and it'll be taxable where you live. Now, let's move on to foreign Social Security benefits. As I mentioned, foreign Social Security benefits may also benefit from this tax treaty. And this is normally your foreign state pension. It might not be called Social Security benefits, but if it is a Social Security funded government benefit, it will generally fall within this clause. And so if you have foreign Social Security benefit, check. Is the paying country the one that's taxing it, or is it your residence country? And with that being said, that means normally Social Security benefits that are paid from a foreign country are not taxable, because if it's the paying country, well, the country that's paying it is not the US, so it's not taxable in the US. And then if it's the resident country and you're not living in the US, well, guess what? Again, it's not the US that's taxing it. So generally, that means foreign Social Security benefits may not even be taxable at all. Still reportable. Don't get me wrong, it's still reportable, but it may not end up being taxable. And if you do use a tax treaty benefit, remember to include Form A833 to claim a tax treaty position, because if you don't, there's a penalty of up to $1,000 for claiming a tax treaty benefit without disclosing it. And now we jump to the last topic, foreign pension income that is not state funded, it's not Social Security funded. If you have foreign pension income, it's generally taxable in the US. However, you can claim foreign tax credits. So if you're paying income taxes on your foreign pension abroad, make sure to claim them on your US tax return. If you're thinking, oh, I don't pay that much income tax on my foreign pension income abroad, it's lower than what the US would charge. Keep in mind, there's some strategies around this. So if you have been using the foreign tax credit approach, right? So you're a salaried employee and you had salaried income and you're probably paying, quite some income taxes on that, you would get a carryover for 10 years. And foreign pension income falls into the same bucket as foreign salaried income, the general bucket on Form 1116. I'm probably going to lose you, but just try to hang on there with me. If you have had salaried income and you've been claiming income taxes on it, foreign income taxes, and you didn't use all of it in the year that you had claimed those income taxes, you can generally roll that over for the next 10 years, which means that when you retire, even if your income taxes on your foreign pension income is a little bit lower, you can still draw from all the income taxes that you paid on your salaried income for the last 10 years if you have access foreign tax credits to then lower your US tax burden. So definitely, I think that is a good reason why those that are close to retiring should definitely opt to use the foreign tax credit approach if they can, because you can accumulate those carryovers. Now, again, when we're looking at foreign pension, I think the most difficult thing is understanding what is taxable. Because as I mentioned, only anything above your basis is taxable in the US. But what is your basis? What is your cost basis? So imagine me, I'm a salaried employee and I have a company pension. What I do is I do a salary sacrifice, right? So part of my salary goes to my company pension, not Social Security, but a different company pension. And then my employer also contributes to this pension. Now, when I'm filing my tax return for that year, assuming that I'm not in a country where I can defer those contributions made in the year, I would be essentially reporting my gross salary before any type of salary sacrifice. And then I would also be, in addition, reporting how much my employer contributed to my pension. And that would all be taxed as compensation in the year contributed. I should keep that on record to understand, what did I contribute? What did my employer contribute? And yes, I tax that on my tax return in the US. Because now, fast forward 10 years later, and I'm retired and I'm starting to pool for my pension, what you need to do is understand, how much did you invest in your pension contract that was taxable in the US. And then from there, you would then look at how many pension payments are you expected to have per year? How long do you think you'll have pension payments for? And then there's a little bit of a more in-depth calculation. It's called the general rule, that will essentially say, this is the tax-free amount of your pension that you can apply to each pension distribution on your US tax return for the rest of your life. So you would go and make that calculation and say, okay, of my $5,000 distribution per month, that's pretty good distribution, 3,000 of it is tax free. And so you report 5,000, but only 2,000 is taxable. This is a more complex calculation. As I mentioned, we do have this calculation in our planning tool, so you can already go in and start kind of playing with those numbers. You can always ask one of our tax professionals in our hire support plans to kind of help you out with that calculation. But it is something most expats will not do because of the complexity, and then you end up effectively being double taxed on your pension distributions, because you've already had your contributions taxed once, and now you're having your full distribution taxed again. So I hope this, brief, concise, but hopefully informative overview helped you out to just think, you know, how can I continue to plan for retirement if you're not at that stage yet? So just to summarize up, you can, still contribute to US Social Security benefits if you wanted to. You can still contribute to a US IRA. If you are thinking about, foreign plans, there's of course more tax complexities, but you know now what would be taxable when you go and withdraw from those pension plans. So whether you're planning, whether you're about to retire, or whether you're already retired, if you have any questions, don't hesitate to let us know. If you want to use My Expat Taxes, you can file in as little as 15 minutes. We have a great expat tax offer for you. I know that because I'm the one that moved abroad and I saw there was no expat tax software on the market that really fulfilled our needs. And as we continue to grow, we continue to add to what we can support, being the most comprehensive tax software out there, with tax treaty integrations, understanding if you should use the foreign earned income exclusion or the foreign tax credit approach, having planning tools for you, having the ability to work with tax professionals side by side to really understand your tax situation. So whatever you need, we are here for you. We know taxes are taxing, so we only want to help make that process a little bit smoother and hopefully even just not something you dread every single year. You can always email us at team@myexpattaxes.com, and we're happy to help you there.